Welcome to another episode of The Balancing Act, a podcast created by SingerLewak to provide relevant information to the public on a variety of topics, including estate planning. We understand the importance of leaving a legacy to your loved ones and are here to help with proactive planning to mitigate the burden of taxes on your estate and to provide a helping hand with administration. In this episode, we are focusing on Long-Term Care Awareness Month.
Hello, listeners. Welcome to another edition of the podcast, The Balancing Act. I'm Lara Buitrago, and I'm a partner at SingerLewak Business Solutions Group. So the Business Solutions Group also puts together podcasts for the Balancing Act, but we call ourselves the Business Buzzcast. So this is another edition of the Business Buzzcast, and we are so happy that you are listening to us right now. Go back and check out some of our other episodes. We have some great episodes on business development, client management, and cybersecurity. But today's topic, I think, is a really great topic for you business owners out there. You will hear about some tax advantages and things you need to hear about in relation to long-term health and life insurance. I'm happy to introduce Dina Mabry from BGA Insurance. Dina, welcome.
Thank you, Lara.
Dina is a trusted resource for life and long-term care insurance. She has been in the industry for over 15 years, and Dina has become an absolutely respected consultant to financial advisors, CPAs, and individuals by creatively finding solutions for estate planning, income replacement, and long-term care protection solutions. This is an area that I think a lot of us are probably seeing with our parents or grandparents, and we'll definitely encounter that. It's not just something personal, but our country does have an aging population. And I think because of that, long-term care is emerging to be a very serious issue for this country, because obviously we want to take care of this aging population. Dina, can you talk about that a little more? Because I think this is a major issue that's going to affect people and also affect businesses.
Oh, absolutely. Well, it's our lucky day because November is actually Long-Term Care Awareness Month. So this is the good awareness. Here we are. Who knew? Yeah, right. This is near and dear to me. And I think, you get up over 50 and you do start thinking, oh boy, what if I live too long? How am I going to afford it? Because living is so expensive. And what we do is we start talking about risk and consequences. And when we have risk and consequences and we bring in some planning, it can really help with the longevity issue. You're right. We have a longevity issue. I don't know if anybody's heard about the term silver tsunami. We're having a silver tsunami starting in 2024.
Well, that's a visual.
and peak 65. Peak 65 is very interesting. I've been reading a lot about this, and it's saying that 12,000 Americans will turn 65 every single day starting next year. So we definitely have a longevity issue, and how are we going to pay for all of this care? Let's see. Okay, first, let's back the train up for a minute. So long-term care awareness. What is long-term care? Long-term care is an extended healthcare event where if you can't do 2 of your 6 activities of daily living, you can have a policy that will turn on and give you tax-free money to have care. You can have the care at home or in a facility. You get to choose. So what are these ADLs, activities of daily living? Well, they're bathing, toileting, transferring, eating, dressing, or having continence or incontinence. Or if you have a cognitive impairment like dementia or Alzheimer's. So unfortunately or fortunately, the longer we live, the more, risk we have of having a long-term care or extended care
event. Somebody's going to get it at some point in your life. Something will affect you, sure.
Something will affect you. And hopefully we're all going to live these long, great lives. And, if we need care, I have set it up with my children that I have a long-term care policy, and so does my husband. And I tell them, look, Dad and I have long-term care insurance because The way we want this to work is we want to stay in our house. We want you to hire caregivers to come in and take care of us. We want you guys to come over and watch Netflix with us. We do not want you bathing us, toileting, transferring us. That's just not part of your job description. So we've made these plans. Now, business owners have a very good benefit that they can actually pay these long-term care premiums from their business. Now, what kind of business and all of the different nuances we can dive into, and I don't even think we have enough time here. But if it's a C Corp, that's golden because you can eliminate some of the retained earnings and pay the premiums right out of the business. And then, of course, we have the pass-through entities, and we have age-based limits and in different categories that we'll fall in. But that's for the CPA to really help us navigate. But business owners have that benefit because long-term care expenses can be deemed a medical health expense. Mm-hmm. So that can be paid out for the business. So for example, I'm working with a business owner right now that happens to be a C Corp, and she is paying her premium through her business as the check with the company check to the carrier. And she's only going to pay her premiums for 10 years. She's 55 years old. So when she's 65 years old, her long-term care policy will be 100% paid up. But the best news is within a long-term care policy, the long-term care benefits grow every single year, 3% compounding as she's aging. So when she reaches the age of, let's say, 85 years old, she's going to have over $600,000 in long-term care benefits for herself to have benefits.
That's tax-free. That's tax-free, and that could probably carry you for a few years. Hopefully.
Absolutely. And then so let's marry long-term care with life insurance. Most of the hybrid long-term care policies that are available now are on a life insurance chassis. And that means that if, let's say this woman dies peacefully in her sleep when she's 100 years old and she never needs long-term care along the way, all that premium that she put into the policy will be returned to her beneficiaries in the form of life insurance.
Wow. And just the premiums, not that growth.
Just the premiums.
Okay.
Exactly, Lara. So the growth is only on the long-term care benefits, but the life insurance is just a return of premium.
Excellent.
But I think that's still great because if I don't crash my car, nobody gives me anything. I just keep paying my auto insurance, right? So at least something's going to happen with these policies.
Sure. Okay, good.
Yes. I want to tell you a quick story. I got a call last week. I worked with husband and wife attorneys years ago, right when I was new in my career. I want to say it was 2007, 2008. And they bought long-term care policies. And we kept in touch through the years. Much they paid their premiums. And I got a call last week from one of the sons of the wife. The husband had passed away, but the wife was diagnosed with Alzheimer's. And he laughed because he said through the years, they'd be at holiday gatherings, Thanksgivings and Christmases. And the mom would always say, if anything happens to me, call Dina. Call Dina. Dina knows what to do. Call Dina. Well, sure enough, he was calling to say that his mom had Alzheimer's and he and his brother were so thankful because she has $11,000 a month, tax-free for care.
That is excellent.
What a difference that makes. Yes.
Yeah. A relief to you. To the family, of course. And I mean, you guys could see it's very expensive to receive long-term care, especially have somebody come into your home. So I think definitely a weight off their shoulders. Now, with the states getting involved here, what's going on there?
So they're ringing the bell because they're saying we have a longevity problem here. Medicaid, Medi-Cal in California is broke. We have too many people that need our services for the Medi-Cal and the Medicaid. So they need money. So what the states are doing, and Washington just did WACARES last year, and we were very involved up in Washington State. They were the first state to do it. And it's a payroll tax for every person that works in the state. Now, what they did in Washington, and I don't know if they're doing this in California, but it's on the docket, is every person that works in the state of Washington will pay $600 per year per $100,000 they make. So if you make $100,000, you're going to pay $600 a year in payroll tax. Now, this money is going to be gathered up and go into this fund. And if you need care, you will receive $36,000. That's it.
Okay.
Which is about $3,000 a month over 1 year of benefits.
Well, that might not cover the expenses, will it?
It probably won't. And a lot of the clients that I was talking to in Washington were saying, wait a minute, if, because of their high income, I mean, don't forget in Washington, we have Boeing and Microsoft and a lot of very big companies with a lot of people making money for their income. And they're saying, I could be paying in more to this tax than I would ever receive out.
Yeah, for sure.
And that would not be good. So California is looking at this too, because we have a longevity issue. And what they did in Washington is they allowed people 9 months to buy a policy and opt out of the tax. Well, as you can imagine, it was a fire sale and people were rushing to the market to try to get policies to opt out of the tax, and carriers started pulling out of the state. They couldn't handle all the applications.
Wow.
So we're a little concerned about what's going to happen here in California because, of course, we're like, 4 or 5 times bigger than Washington?
We are.
So I would say if long-term care is on your radar, it's good to look at it sooner than later.
Right, because you're going to end up paying possibly, and again, I'm stressing again, nothing's been signed yet, but you're possibly, everybody, no matter what age you are, if you're working, you're going to pay $600 for every $100,000 you make. I believe you said, Dina. Mm-hmm. So you're going to be paying it anyway. Maybe just look to see if it's worth it to seek something else so that you can opt out. So I think, again, lots of thinking that we have to do for the next few, maybe years or a year, who knows how long it's going to be. But obviously there's options out there and we want everybody to be as informed as possible. Now, from the business standpoint, this also means, because my understanding is the payroll tax, it's not just employee tax, but is it also an employer tax?
I'm not sure that it's an employer, but let's say you are a pass-through entity, you will pay. Right. You're not going to be able to opt out just because you own an S Corp or a sole prop or an LLC.
Okay.
So it will be anyone who works in the state of California. And Oliver Wyman and everybody can do some research on this if they Google it, but Oliver Wyman is the consultant that's in here right now. And they're supposed to come with their findings in January of 2024 and say what they think and the viability of this program in California with so many people. So it's real. It's real. There's 13 other states besides Washington's the only one right now that's in force. They came in force July 1st of 2023. And then 13 other states are looking at it too. So, I mean, I'm a big believer in you got to take the bull by the horns, right? Plan for yourself, protect your own family. And I mean, especially if there's Alzheimer's in your family or there's longevity in your family, it's good to plan and it's good to have tax-free money for that long-term care. Because I get some clients that say, well, it's fine. I'll just sell my house or I'll just start selling my investments. Well, what if the market's down? What if the housing market's down? What if you want to keep your house? What if you want to live in your house? So it's another option.
I think from a personal standpoint, what I've seen and what I've observed in some of the family members, relatives, and friends is they want to be at home. So maybe selling that house might not be an option. Right. You want to be in your home, in your space where people can freely come and visit you. Rather than a facility or some sort of residential place might not be the best for you. So selling the house might not be the way to go. So most people have an idea in the general sense what life insurance is. You get a plan, you pay your premiums for a few years, and if the policy is active when you pass away, your named beneficiaries will get money. That's in the general sense.
Exactly.
But what a lot of people don't know is that there are different types of life insurance and even life insurance with a savings component. So I know that there's a lot out there, but I would love it, Dina, if you could go through maybe the 2 more popular types of life insurance that our listeners would be interested in hearing about.
Perfect. All right. So everybody knows about term insurance. Term insurance is for a specific term. So let's say you pick a term length of 10, 15, 20 years, and that means you'll have coverage for your business or your family should you pass away during that time. And the good thing about life insurance is that the life insurance proceeds are totally tax-free. So whoever you name as your beneficiary will receive that money and not pay tax on it. Term insurance is so inexpensive, especially if you're young and healthy. It is based on health and age. So the younger and healthier you are, the less expensive it is. I really am a believer in term insurance. I like term insurance, especially for key man, key woman, buy-sell agreements for business owners. One example we could talk about, Lara, is if you and I were business partners and one of us passed away, what would happen to the business?
Absolutely.
And
very important question, guys.
Yes. And I know you don't want to be in business with my husband, Jeff. He's a lovely individual, but you don't want to be in business with him. So
Right.
If we had a life insurance policy, let's say you had $1 million for you and I had $1 million for me and I passed away, that $1 million would go into our business. And then you can use that money to keep the business running, find someone to replace me. And then you can also pay off Jeff so you don't have to be in business with him. It works so well with a buy-sell agreement. And a lot of business owners just don't take that extra step to.
And would that insurance be, with the premiums for that insurance, that would be a business expense, correct?
It would. We like to set it up that the owner and the beneficiary is the business.
Okay. That
And
makes
the payer.
sense. It's
Yes.
and possibly a tax deduction.
Exactly. What it is really is just an expense for the business.
Perfect. Okay.
Now, there's another type of life insurance, and it can be a retention tool for maybe a key employee. And that's more of a permanent life insurance policy where the premium is paid by the employer, but the benefits after a set number of years will go to the employee. So maybe if you're my employee, Lara, and I say to you, oh, you're so important to my business, I really need you to stay around. We could set up a life insurance policy where after 10 years, you would be transferred the life insurance policy because you stayed and worked so hard in my business.
Oh, okay. And then, so if I hate to be morbid, but if I pass away, then I own that life insurance and my main beneficiaries would receive that money.
Exactly. But for the first 10 years of the policy, your employer, me, I would be paying your premiums for you. And there's some logistics that we would work through. But think about, protection for the business if someone were to pass away, for a key person, the owners for the buy-sell agreement. But then also think about a retention tool for key employees. We can use life insurance there as well.
Okay. And I know that, and some folks might be interested in this, there are life insurances that have a savings component. Can you go into that a little bit?
Absolutely. So I get this question a lot. Clients are working with their CPA and working with their financial advisor, and they've maxed everything out. They've maxed out the 401k, the SEP, all the retirement vehicles. And they said, okay, what else do you have? Well, you can overfund a life insurance policy. I use indexed universal life, and every carrier has one, and I have my favorites. But what will happen is you will have a death benefit, but you'll be paying premium into the life insurance policy. And the goal really is to accumulate cash. So we have it in the life insurance chassis so that it is not a quote unquote investment, but what it is a savings vehicle. So it becomes a bank that you take loans from should you need cash. And of course, we all know that loans are not taxable. So there's some ins and outs, but it works very, very well, especially for high income earners.
Wow. Okay. Well, that is some excellent information. I think hopefully some listeners out there are getting some ideas and can take advantage of some of these instruments that are out there. But the other question is, we probably have some young listeners. At what age should someone start looking into life insurance?
That's a great question. So I always say if someone is going to suffer financially, if you were to pass away, then you need life insurance, because really what you're doing is you're replacing yourself financially with a policy. So if you have children, you have a spouse, you have a mortgage, you have a business, if there's going to be a financial loss, if you are not here to provide for the business or your family, then you should get life insurance. Most people wait until they either are married or have a house or have a business or a mortgage and have some expenses that require a life insurance policy to protect them. So what age is that? It seems to be getting older and older that clients are getting married, but it can be anything. I did buy my children life insurance policies when they went off to college. And the reason why is because I wanted to also lock in their insurability. I see people getting diagnosed with disease. And if you even get a term policy, let's say you got a 20-year term policy when you were 25 years old, even if you get sick when you're 30 or 35, your insurability is locked in because you bought it when you were healthy and young.
Wow. Okay. So that could mean some major cash flow savings down the line for these people's lives.
Absolutely.
Locked in. Okay. Well, that's excellent to know, and hopefully can help folks with some of their financial planning. But
Right.
well, Dina, this is wonderful information. Thank you so much for your time. I think we'll end it right there. I think we gave a lot of the listeners a lot to think about at this point. And again, if you have any questions, Dina's information will be provided as well as mine. Let us know if you have any other questions, want to discuss further. Dina, any last words?
Oh boy. Thank you, Lara. I'm so passionate about this, and I'll talk to anybody anytime. So call me and let's just have that discussion. It really truly is my passion for protection.
Absolutely. And thank you so much for your time. Much appreciated. And we're going to sign off right now. Thank you, everybody.
Thank you for tuning into this episode of The Balancing Act, where we focus on long-term care awareness. We explored the different types of long-term care, their costs and benefits, and the legal and financial implications of your decisions. We're here to help with proactive planning to mitigate the burden of your taxes on your estate and provide administrative services and planning. To learn more, visit SingerLewak.com. If you enjoyed this podcast, please subscribe so you don't miss an episode and share it with those who might benefit from long-term care awareness. Together, we can make a difference in the lives of those who need it most.